For more than 2 decades, there was one trade on Wall Street that traders whispered about the way sailors whisper about storms. They called it the Widowmaker. Not because it made people rich, but because it destroyed them. Again and again and again. The trade was simple in theory. Bet that Japan's government bonds would collapse. And on paper, the logic was flawless. Japan had everything economists said was impossible to survive. Debt larger than its entire economy, a shrinking and aging population, near zero growth, a central bank creating money at historic scale. To many hedge fund managers, this was not a question of if the system would break, only when. So they placed their bets. They shorted Japanese government bonds known as JGBs. They waited for interest rates to rise. They waited for investors to panic. They waited for gravity. But gravity never came. Instead, something else did. The Bank of Japan, the central bank that refused to lose. Every time traders attacked the bond market, the Bank of Japan responded with overwhelming force. It did not negotiate. It did not hesitate. It simply printed money and bought the bonds. Unlimited amounts. Whenever yields tried to rise, the central bank crushed them back down. Whenever sellers appeared, the BOJ became the buyer of last resort. Over time, something unprecedented happened. The central bank didn't just influence the market, it became the market. By the early 2020s, the Bank of Japan owned more than half of all Japanese government bonds in existence. No major economy had ever allowed this to happen before. And yet, the system kept functioning. Japan continued to borrow, interest rates stayed near zero, the government paid almost nothing to service its debt, and the hedge funds lost billions. The Widowmaker earned its name. Careers ended, funds shut down, legends were humbled. It became known as the trade that could not win, until now. Why 2025 is not like before? Something changed, quietly at first, then all at once. In 2024, inflation in Japan, long thought impossible, began to bite. Food prices rose. Energy costs surged, rent increased, and for the first time in decades, ordinary Japanese households felt poorer every month. The weak yen made everything imported more expensive. Public anger grew. Politicians panicked, and the Bank of Japan faced a choice it had avoided for 20 years. Protect the bond market or protect the currency. It tried to do both. It failed. In 2024, the BOJ ended its most powerful weapon, yield curve control, a policy that promised to cap long-term interest rates. That promise had been the foundation of the entire system. Once it disappeared, markets finally smelled blood. By late 2025, Japan's 10-year bond yield had climbed close to 2%. For most countries, that number is unremarkable. For Japan, it is seismic. Because Japan is not a normal country anymore. It is a mathematical paradox. The debt trap. Japan's government debt is now roughly 2.5 times the size of its economy. To visualize that, if Japan earned $100, it owed $250. This level of debt can survive under one condition only. Interest rates must remain close to zero. At zero, the debt is heavy but manageable. At 2%, it becomes dangerous. At 3%, it becomes lethal. Japan already spends nearly 1/4 of its national budget just paying interest, even at extremely low rates. As old bonds mature, they must be replaced with new ones at higher interest. Each percentage point increase adds tens of billions of dollars in new costs every year. If average interest rates reached just 2%, Japan's entire tax revenue would be consumed by debt payments alone. No healthcare, no pensions, no military, no infrastructure, only interest. This is not theory, it is arithmetic, and arithmetic does not negotiate. the central bank's impossible choice. The Bank of Japan is now trapped between two disasters. Option 1, allow rates to rise naturally. The currency stabilizes, inflation slows, but government finances implode. Banks collapse under bond losses. Thousands of companies go bankrupt. Option 2, resume massive bond buying. The government survives, banks are protected, but the yen collapses. Inflation explodes, living standards fall sharply. There is no third option. There is no safe compromise. Every policy now causes damage. The BOJ calls its strategy gradual normalization. Markets call it denial. The return of the widowmaker. Hedge funds have noticed. They are back, but this time the trade is different. They are no longer betting only on bond prices. They are betting on the limits of political reality. They believe the central bank will eventually panic. They believe when yields approach a dangerous threshold, maybe 2.5%, maybe 3%, the BOJ will abandon restraint. They believe the printing presses will restart, and history suggests they are right. Central banks do not allow governments to default. They sacrifice currencies instead. A new problem, the people. In the past, Japan had a powerful ally, its own citizens. Japanese households saved heavily. Banks bought government bonds. Pension funds supported the system. The debt was recycled internally. But inflation changed everything. A bond yielding 1.8% in a country with 4% inflation guarantees a loss. Slowly, Japanese savers are stepping away. Banks are reducing purchases. Insurance companies are hesitating. Foreign investors are cautious, and the Bank of Japan is becoming the only buyer left. A market with one buyer is not a market. It is a command economy. And command economies do not send honest price signals. No one knows what Japanese bonds are truly worth anymore. 2%? 4%? 7%? No one dares to find out. The world's ATM is reversing. For 30 years, Japan played another role in the global system. It exported capital. Because returns at home were zero, Japanese institutions invested abroad. U.S. government bonds, European debt, global stocks, corporate loans. Japan became the largest foreign holder of American government debt. This money kept global interest rates low. It lubricated the world economy. But that flow is reversing. As Japanese yields rise, investors bring money home. This process is already visible, and it terrifies bond markets in Washington and Brussels. If Japan stops buying, who will replace them? If demand falls, yields must rise, and rising yields hit every mortgage, every business loan, every government budget. Japan's problem is becoming everyone's problem. The fuse has been lit. The widowmaker trade never died, it only waited. Now the system it bets against is weaker than ever, older, more indebted, politically constrained, financially fragile. Japan has built the most extreme monetary experiment in history. And experiments always end, not with balance, but with consequences.
For decades, one of the quiet engines of the global financial system was something most ordinary people never saw. It did not appear in headlines, it was not debated in parliaments, yet it moved trillions of dollars across borders and shaped the price of nearly every asset on Earth. It was called the carry trade, and Japan was its heart. The logic was simple. Borrow money where it is cheap, invest it where returns are higher, keep the difference. Because Japan kept interest rates near zero for most of a generation, its currency became the world's favorite source of cheap funding. Banks, hedge funds, corporations, and speculators borrowed yen at almost no cost, converted it into dollars or euros, and poured it into anything that offered yield. American stocks, emerging market bonds, European real estate, crypto, private equity. The details differed, but the foundation was always the same: free money from Japan. Over time, this trade grew into something enormous. It was no longer a strategy used by a few aggressive hedge funds. It became a structural feature of the global economy. Pension funds relied on it. Investment banks built entire desks around it. Corporations quietly used it to lower financing costs. No one knew the exact size, but estimates ranged from several trillion to well over $10 trillion in exposure. As long as Japanese interest rates stayed near zero and the yen remained weak or stable, the machine worked beautifully. Borrowers paid almost nothing. Assets abroad rose in value. Profits compounded. But the carry trade has one fatal weakness. It is safe only when nothing changes. And in 2025, everything is changing. When the Bank of Japan allowed interest rates to rise, even slightly, it altered the mathematics of this global machine. Borrowing yen was no longer free. The cost crept upward quarter by quarter. At the same time, capital began flowing back into Japan as local bond yields finally offered something resembling a return. That reversal matters more than most people realize. When Japanese institutions bring money home, they must sell what they own abroad. They sell foreign bonds. They sell stocks. They unwind complex derivatives. They close leveraged positions. Every sale pushes prices down. Every repayment strengthens the yen. And a stronger yen makes the carry trade even more painful because borrowers must buy back more expensive yen to repay their loans. This is how orderly repositioning becomes panic. A trader who borrowed 10 billion yen when $1 bought 150 yen suddenly faces a nightmare when the exchange rate moves to 130 or 120. His debt just became dramatically more expensive in dollar terms. If he is leveraged, he does not have time to wait. He must sell. When thousands of institutions do this simultaneously, markets do not adjust gently. They snap. We saw a hint of this in 2024 when a small change in language from the Bank of Japan triggered a sudden spike in the yen and a sharp global sell-off. Stocks fell, bonds dropped, volatility exploded for days. That was only with a whisper of tightening. Now imagine a sustained cycle. Rising Japanese yields, repatriation of capital, strengthening yen, forced liquidations abroad. This is not a theoretical scenario, it is a mechanical one, and the scale is unprecedented. Japanese pension funds alone manage trillions of dollars. Life insurance companies control enormous portfolios of foreign debt. Government-linked institutions invested abroad not because they wanted to, but because they had no alternative at home. As yields rise domestically, their incentives flip. Why take currency risk in America for 4.5% when you can earn 2% at home with zero political risk and regulatory safety? Why expose retirees to foreign market volatility when the domestic bond market finally offers something positive? Even a modest shift in these preferences drains liquidity from the global system. Liquidity is the oxygen of finance. When it disappears, prices do not decline slowly, they gap lower. The first victims are bond markets. American government debt depends heavily on foreign buyers. Japan is the largest among them. When Japanese demand weakens, the U.S. Treasury must offer higher yields to attract replacement buyers. Higher yields mean higher borrowing costs for Washington. That means larger deficits, which require more borrowing, which require even higher yields. It is a feedback loop that policymakers pretend does not exist until it does. Europe faces the same risk. So do emerging markets, which depend on foreign funding to roll over their debts. This is the hidden danger of Japan's normalization. It does not stay in Tokyo, it propagates outward through portfolios, balance sheets, and algorithms. But the carry trade is only one side of the storm. The other is psychological. For 30 years, global investors treated Japanese stability as permanent. Zero rates were assumed. The yen was assumed to be weak but predictable. Japanese capital flows were considered reliable. That assumption shaped risk models, pension strategies, and sovereign financing plans. When a foundation changes after 30 years, the structure built on top of it becomes unstable. Volatility rises, risk managers reduce exposure, banks tighten lending, credit spreads widen, growth slows. None of this requires a crisis headline. It emerges gradually, like pressure building along a fault line. Then something breaks. Often, it is not Japan itself that provides the trigger. It is a secondary market, a hedge fund unable to roll its yen funding, a regional bank in Europe suddenly short of liquidity, a U.S. corporate bond auction that clears at unexpectedly high yields, a pension fund that fails to meet collateral requirements. These are the sparks that ignite a system already saturated with dry fuel. And there is another layer still. Many of the carry trade positions are hidden inside derivatives, interest rate swaps, currency forwards, structured products sold to institutions that barely understand the risks they hold. These instruments amplify small moves into catastrophic losses. When the yen rises quickly, margin calls arrive within hours. Institutions must post cash immediately or liquidate assets. They do not sell carefully. They sell whatever they can. Treasuries, blue-chip stocks, investment-grade bonds, emerging market debt. This is how a currency adjustment becomes a global asset crash. And because the carry trade is interconnected, selling in one market triggers losses in another, forcing more selling in a cascading loop. Modern finance is efficient. It is also brittle. The more optimized it becomes, the more fragile it grows. Japan unknowingly provided the cheap foundation for this structure for decades. Now it is withdrawing it, slowly, reluctantly, but inevitably. The great irony is that Japan is not trying to destabilize the world. It is trying to survive. It is trying to protect its currency, calm inflation, and preserve political legitimacy. But the tools it uses operate on a global scale. When Japan shifts, the planet feels it. The coming bond shock will not announce itself with a single dramatic collapse. It will arrive as a sequence. Rising yields in America, liquidity thinning in Europe, volatility becoming permanent, assets repriced downward, leverage shrinking. Then one day, something will fail. A fund, a bank, a sovereign auction, and suddenly everyone will remember that stability was borrowed from a country that no longer exists in the same form. Japan's era of zero is ending. The world was built on it, and what replaces it will not be gentle.
Inside Japan, away from the headlines about exchange rates and government debt, a quieter and more dangerous problem has been growing for years. It sits on the balance sheets of banks. It hides in footnotes. It is disguised by accounting rules and technical language, but it is real, and it is enormous. Japan's banking system was built for a world where interest rates never moved. For decades, banks accepted deposits that paid almost nothing. To earn even a tiny profit, they bought long-term government bonds yielding 0.1%, 0.2%, sometimes even less. It was not exciting, but it was safe, or so it seemed. When interest rates are near zero forever, bond prices barely move. Losses stay invisible. Risk models show stability. Regulators relax. Then rates rise, and the math changes instantly. A bond that pays 0.1% becomes deeply unattractive in a world where new bonds pay 2%. Investors will only buy the old bond at a discount, sometimes a severe one. That discount is a loss. Japanese banks hold vast quantities of these low-yield bonds, not just the mega banks in Tokyo, but hundreds of regional banks scattered across small cities and rural prefectures. These institutions finance local businesses, farmers, construction firms, and households. They are the financial bloodstream of the country. On paper, many of these bonds are still recorded at face value because the banks claim they will hold them until maturity. In reality, their market value has already fallen sharply. The losses exist. They are simply not yet acknowledged.
This is what accountants call unrealized losses. History shows what happens when unrealized losses meet fear. In 2023, Silicon Valley Bank in the United States collapsed for exactly this reason. It owned long-term bonds purchased at low yields. When U.S. rates rose, the value of those bonds collapsed. Depositors panicked. The bank had to sell. Losses became real. Capital vanished. The institution died in days. Japan's situation is similar but far larger. Instead of one bank, there are dozens. Instead of billions, there are hundreds of billions. Instead of one country, the shock would echo globally. And bonds are only the visible layer. Beneath them lies something more volatile: derivatives. For years, Japanese banks used interest rate swaps to manage their exposure. In simple terms, they made side bets on the direction of rates to protect themselves if yields moved. Some swapped fixed payments for floating ones. Others did the opposite. Some used swaps to boost income in a low-rate world. Over time, these positions multiplied. They were considered safe because rates never moved. But derivatives are non-linear. Small changes in interest rates can produce massive changes in profit and loss. When rates rise slowly, banks adjust. When rates jump suddenly, the math explodes. A 1% move in long-term rates can translate into trillions of yen in derivative losses across the system. These losses do not appear in newspaper headlines. They appear as margin calls, cash demanded immediately. If cash is not delivered, positions are liquidated, assets are sold, prices fall, and falling prices trigger more margin calls. It is a chain reaction. Japanese regulators know this risk well. They have a word for it. They call it a VAR shock, value at risk. VAR models estimate how much a bank might lose in extreme conditions. When volatility increases or rates jump, these models suddenly show unacceptable risk. When that happens, banks are forced by internal rules to reduce exposure immediately. They sell bonds, they close positions, they cut lending. If many banks do this simultaneously, markets collapse. Japan experienced a mild version of this in 2003, when bond yields tripled in weeks. Even then, the damage was serious. Today, Japan's debt is far larger. The banking system is more leveraged. The derivatives market is vastly more complex. A similar shock now would not be mild, it would be systemic. And the danger does not stop at Japan's borders. Japan's largest banks are global giants. They operate in London, New York, Singapore, and Hong Kong. They hold foreign bonds. They finance international trade. They clear derivatives for hedge funds and corporations. If they face capital stress at home, they will not isolate the damage. They will pull money from abroad. They will sell U.S. treasuries. They will sell European bonds. They will reduce lending to multinational companies. This is how domestic instability becomes global contraction. There is another institution that perfectly illustrates this danger: Norinchukin Bank. It is not famous outside finance, but it controls the savings of Japan's agricultural cooperatives. Farmers, fishermen, and rural households entrust it with their life savings. Because domestic yields were zero, Norinchukin invested aggressively overseas. It became one of the largest buyers of American corporate loans packaged into complex securities. Not because it wanted to gamble, because it had no choice. Yield starvation forces risk. In 2024, Norinchukin quietly announced that it would sell tens of billions of dollars of foreign bonds to cover losses at home. This was a warning, not a crisis, a warning. If Japan's bond prices fall further, such sales will multiply. And when large institutions sell, markets move. Prices drop. Credit dries up. The invisible leverage embedded in derivatives and structured products magnifies the move. At the same time, the Bank of Japan is trapped. If it raises rates to support the yen, it increases losses for banks. If it suppresses rates to protect banks, it destroys the currency. It is trying to walk between two collapsing walls. Sometimes it intervenes, buying bonds to stop yields from rising. Each intervention saves banks temporarily. Each intervention weakens the yen. Each intervention adds future inflation. It is a delayed cost. But delay does not remove it. It compounds it. Meanwhile, confidence erodes. Depositors begin to ask questions. Is my bank safe? Is my savings losing value? Should I move my money? Even small shifts in public behavior can destabilize fragile institutions. If regional banks experience withdrawals, they will be forced to sell bonds at losses. Those losses will erase capital. The government will be asked to rescue them. Rescue means more borrowing. More borrowing means more bonds. More bonds require buyers. The buyer is the central bank. The circle closes. This is the hidden leverage bomb. Not a single trigger, not a single villain, but an entire system designed for a world that no longer exists. A world of zero rates, zero volatility, infinite stability. That world is gone. The system remains. And systems that outlive their environment do not adapt quietly. They break. And when they do, the headlines will talk about exchange rates and bond auctions. But the real story will be written in bank balance sheets, margin calls, and derivatives contracts few people ever see. Japan will not collapse in one dramatic day. It will leak through capital holes, through silent rescues, through shrinking credit, through weakening currency, until one morning the world realizes that one of its financial pillars has become hollow. And when pillars fail, roofs do not fall gently.
When confidence in a country's financial system weakens, it does not disappear all at once. It drains slowly, like water leaking through invisible cracks. The first place this loss appears is not in stock prices or bond yields, but in the currency. A currency is not just paper or numbers on a screen. It is a promise that tomorrow it will still buy something meaningful. When that promise weakens, behavior changes. People stop saving. They rush to spend. They look for anything that cannot be printed. Japan is beginning to enter this phase. For decades, the yen was considered one of the world's safest currencies. During crises, investors bought it as protection. It was stable, predictable, boring. That reputation is now fading. Each time the Bank of Japan intervenes to suppress bond yields, it prints more yen. Each time it prints more yen, it weakens the currency. Each time the currency weakens, imported goods become more expensive. Japan imports most of its energy. It imports large amounts of food. It imports industrial raw materials. A falling yen is a tax on every household and every business. At first, the decline is tolerable, 10% here, another 10% there. But psychology shifts when depreciation becomes persistent. Workers realize their wages buy less each year. Retirees see their savings eroded. Companies face rising input costs. People begin to plan around decline instead of stability. They move money abroad. They buy foreign assets. They buy gold. They buy anything that is not yen. This is capital flight. At first, it is subtle. A few extra accounts opened in Singapore, more dollar deposits, higher demand for foreign stocks. But once expectations change, flows accelerate. The central bank notices reserves falling. Bond auctions grow weaker. Foreign investors demand higher yields. The feedback loop tightens. To defend the currency, the Bank of Japan would normally raise interest rates, but raising rates would crush government finances and banks. So the currency continues to slide. Markets sense the constraint. Speculators test it. Each test weakens the yen further. This is how orderly depreciation turns into collapse. And a collapsing currency does not remain a domestic problem. It exports instability. As the yen weakens, Japanese exports become cheaper. Cars, electronics, machinery, chemicals. A weaker currency makes Japanese products undercut competitors. For Japanese companies, this is a lifeline.
For the rest of the world, it is a threat. South Korea cannot allow its manufacturers to be priced out. Neither can Taiwan, neither can China. When one major economy devalues, others follow, not through announcements, through quiet intervention. Central banks buy dollars, they sell their own currency. They deny it publicly, they do it anyway. This is how currency wars begin. No declarations, no formal battles, just endless attempts to avoid being the most expensive producer. The result is global deflation in manufactured goods and rising tension between governments. The United States begins to accuse others of manipulation. Tariffs are proposed. Politicians demand protection. Supply chains are disrupted. Trade slows. Investment retreats. Growth weakens, all triggered by a falling yen. China is the most dangerous link in this chain. If Japan's currency collapses far enough, Chinese exporters become uncompetitive overnight. China's economy is already fragile. Debt is high. Real estate is weak. Growth is slowing. A surge of cheap Japanese exports would be devastating. In that scenario, China would likely respond with a major devaluation of its own currency, a single large move, not gradual, not subtle. Such a move would send shockwaves through commodity markets, emerging economies, and manufacturing industries across the world. It would also provoke political retaliation, tariffs, sanctions, technology restrictions. The smooth system of global trade that defined the last 30 years would fracture. This is how financial crises become geopolitical ones. But Japan has one tool left to delay this chain reaction: capital controls. No major developed economy wants to use them. They are associated with failed states and desperate regimes. They signal that money is trapped, that rules can change overnight, that trust has evaporated. But capital controls are powerful. They stop money from leaving. They force domestic savings to remain inside the system. They create artificial demand for government bonds. They stabilize currencies temporarily, and they buy time. Japan has not implemented them yet, but the idea is no longer unthinkable. At first, controls would be indirect. Banks quietly discouraged from facilitating large foreign transfers, extra reporting requirements, taxes on overseas investments, limits on foreign currency withdrawals. Officially, these would be described as prudential measures. In reality, they would be barriers. If pressure continued, restrictions would harden. Corporations would need approval to move profits abroad. Pension funds would be required to hold domestic bonds. Households would face limits on dollar purchases. At that moment, Japan would cease to be a fully open financial system. It would join the category of countries investors treat differently, with suspicion, with risk premiums, with shorter time horizons. Trust once lost is slow to return. Capital controls would stabilize the bond market for a time, but at a cost. Foreign investment would dry up. Innovation would slow. The stock market would shrink. Young talent would leave. The currency would remain weak because credibility would be damaged, and Japan's role as a global financial center would fade. The tragedy is that this outcome is not the result of one mistake. It is the accumulation of decades: low growth, aging population, debt-financed stability, central bank intervention replacing structural reform. Each decision made sense in isolation. Together, they built a trap. The currency sits at the center of it. If the yen collapses, living standards fall. If living standards fall, politics destabilize. If politics destabilize, policy becomes erratic. If policy erratic, erratic, markets flee. It is a cycle no central bank can fully control. History offers many examples: Argentina, Turkey, Russia in the 1990s. But Japan is different. It is large, integrated, systemic. A crisis there is not regional, it is global. And unlike emerging markets, Japan's debt is woven into every major financial institution, every pension fund, every central bank reserve portfolio. A disorderly yen collapse would force revaluation of what is considered safe. It would change how governments finance themselves. It would alter how savings are protected. It would alter how trade is conducted, all from one currency losing its anchor. For now, Japan walks the line, intervening carefully, raising rates slowly, printing cautiously, hoping psychology holds. But currencies do not collapse when data deteriorates. They collapse when belief breaks, and belief is fragile. Once people decide a currency is meant to fall, it usually does, not because of conspiracy, because millions of rational decisions align in the same direction: sell, convert, protect, escape. When that happens, central banks are no longer in control. They are spectators with printing presses, and printing presses do not create trust.
Every financial system eventually reaches a moment where it must reveal what it truly values, not in speeches or policy papers, but in action. In Japan, that moment is approaching. For years, officials insisted that normalization was possible, that interest rates could rise gently, that the currency could be stabilized, that debt could be managed without pain. But systems built on contradiction do not resolve gracefully. They choose. And Japan's system has only two choices: protect the bond market or protect the currency. History tells us which one governments choose. They protect the bond market. They protect the banks. They protect the state, and they allow the currency to absorb the damage. This is the quiet end game. Not collapse in a single day, not empty shelves or burning buildings, but a slow transformation where the numbers remain intact while their meaning dissolves. The government will pay every bond, on time, in full, in yen, but those yen will buy less each year. This is not default in law, it is default in reality. A teacher who saved for 30 years will discover her retirement buys half of what she planned. A pension fund will meet its obligations on paper while failing them in life. A nation will remain wealthy in statistics while poorer in experience. This is how debt dies without being forgiven, through inflation, through depreciation, through time. Japan will likely continue this path because it is politically survivable. Raising taxes is visible. Cutting pensions is explosive. Allowing inflation to erode value is subtle. It spreads blame. It avoids headlines. It creates no single moment of outrage, but it changes society. Trust weakens. Long-term planning fades. People choose speculation over saving. Young workers leave. Old workers spend quickly. The social contract erodes quietly. Yet the larger consequence will not be confined to Japan. When a G7 nation effectively proves that sovereign debt is not risk-free, the foundation of global finance shifts. For half a century, government bonds were treated as the safest asset in existence. Banks held them as risk-free capital. Pension funds built portfolios around them. Central banks stored them as reserves. Derivatives were priced off them. Everything was anchored to the belief that a major government would always preserve the real value of its obligations. Japan will challenge that belief, not through dramatic default, but through purchasing power collapse. Once investors internalize this lesson, they will demand compensation, higher yields, shorter maturities, inflation protection, harder terms. This repricing will not target Japan alone. It will spread to every heavily indebted nation: the United States, the United Kingdom, France, Italy, any government that relies on constant refinancing. The age of cheap money will end not because central banks choose it, but because markets refuse to subsidize states indefinitely. Borrowing will become political again. Budgets will face real limits. Promises will require funding. Deficits will no longer be abstract. They will be expensive. And when borrowing becomes expensive, societies change. Housing becomes less affordable. Speculation becomes harder. Growth slows. Asset bubbles shrink. A new era begins. Not prosperous, not catastrophic, but constrained. In such an environment, the definition of safety changes. Paper claims lose their charm. Long-term promises issued by heavily indebted governments are no longer treated as stable stores of value. Investors begin to look elsewhere, not for maximum return, but for durability. Assets that do not depend on a central bank's credibility. Gold will benefit. It always does when currencies lose trust. It has no yield, but it has no counterparty risk. It cannot be printed. It cannot be restructured. It exists outside balance sheets. Central banks themselves already understand this. They have been accumulating gold quietly for years. Commodities will gain importance. Energy, copper, agricultural land, physical resources with intrinsic demand. They fluctuate. They suffer volatility, but they do not vanish when accounting rules change. Real estate will divide. Not all property will survive, only that which produces income and sits in desirable locations. Speculative developments will fail. Practical housing will remain. Bitcoin and similar assets will continue to polarize opinion. They are volatile, they are political, they are imperfect, but they represent a generation's answer to monetary instability, a digital attempt at scarcity in a world drowning in currency. Some will adopt them, some will reject them, but they will not disappear. Equities will survive unevenly. Companies with real pricing power, low debt, global revenue, essential products, they will endure. Financial engineering will not. Leverage will no longer be free. Buybacks financed by debt will fade. Growth will be slower, but more real. The era ahead will reward resilience rather than cleverness, ownership rather than leverage, patience rather than velocity. Japan's crisis will not be remembered primarily for its charts or its technical details. It will be remembered as the moment the world finally accepted a truth it had avoided since 1971. Debt is not wealth. Printing is not prosperity. And demographics are stronger than policy. The Japanese experiment was the largest and longest attempt to disprove this. It delayed consequences, it softened cycles, it created stability, but it did not repeal mathematics. The widowmaker trade was never just about bonds, it was about belief. Belief that central banks could control reality indefinitely. Belief that debt could grow without limit. Belief that time itself could be managed. That belief is ending. Not in panic, but in recognition. A quiet acceptance that some promises cannot be kept in real terms, only in nominal ones. And that safety does not live in documents, but in things that do not require trust to exist. Japan will continue. Its people will adapt. Its culture will endure. But its financial model will not be copied again. The rest of the world is watching, not with curiosity, but with fear. Because Japan is not unique. It is early, and what happens there is not the exception. It is the preview.